economy is collapsing, jobs are disappearing, businesses are shutting their doors, and yet some people are getting richer than ever. Not slowly, not accidentally, systematically. Money is moving upward the same way it always does, even when everything below it is breaking. That sounds unfair. It sounds conspiratorial, but it's neither. It's how the system is built. And right now, it matters more than most people realize. Because when economies collapse, we're told a familiar story, that everyone suffers, that markets fall together, that pain is shared. But history tells a quieter, more uncomfortable truth. Crashes don't destroy wealth, they relocate it. And the direction is almost always the same: up. Let's start with something simple. Money does not behave like emotions. It doesn't panic. It doesn't hope. It doesn't wait. Money follows incentives. And incentives don't disappear in a crisis. They get sharper. When an economy expands, growth feels democratic. Jobs are plentiful. Credit is easy. Assets rise together. It feels like the system is working for everyone. But expansion hides structure. Collapse reveals it. When things break, the rules become visible. Take debt. Most people think debt is a personal issue, a loan, a credit card, a mortgage. But zoom out, and debt is the backbone of modern economies. Governments run on it. Corporations depend on it. Financial markets are built around it. And here's the key detail. Debt has hierarchy. Some debt is protected, some debt is disposable. When the economy contracts, payments don't stop evenly. They stop at the bottom first. Households default, small businesses fail, workers lose income. But the debt they owe doesn't vanish. It gets sold, restructured, absorbed, often at a discount, which means someone else buys it, cheaply. That someone else usually has cash, access to credit, or both, and those players sit higher in the financial food chain. This is where money starts moving upward, not through theft, through mechanics. Consider assets. During crashes, prices fall, stocks drop, real estate weakens, businesses lose valuation. Publicly, this looks like loss, but privately, it's opportunity. Because price is not value, price is urgency. When people are forced to sell, they sell fast. When institutions buy, they buy patiently, and patience compounds. During every major crisis, the Great Depression, the 1970s stagflation, the 2008 financial crash, the pandemic shock, the same pattern repeats. The largest asset holders increase their share, not because they predict the crash, but because they survive it. Survival is leverage. Here's the uncomfortable math. If you have no savings, a downturn forces decisions. If you have cash, a downturn offers options. If you rely on income, you wait. If you own assets, you shop. That gap is structural, and it widens precisely when the system is stressed. Now layer in financial markets. When panic hits, markets don't just fall, they fragment. Retail investors pull out, funds rebalance, algorithms follow rules, but central banks step in. They lower interest rates, they inject liquidity, they stabilize bond markets. This is often framed as saving the economy, but what they are really saving is the system of credit. Because if credit freezes, everything stops. The side effect is predictable. Low rates inflate asset prices. Stocks recover faster than wages. Housing rebounds before incomes. Capital markets heal long before labor markets do. So while the public feels recession, balance sheets quietly recover. This isn't hidden. It's just technical enough to feel distant. Now add time. Crises are temporary. Ownership is permanent. When a worker loses a job, income stops immediately. When an asset loses value, ownership remains. As long as you don't sell, you still own. And the largest players rarely need to sell. They can wait years. This is where irony creeps in. We're told markets reward risk-taking, but during collapses, markets reward insulation. The less exposed you are to daily survival, the more advantage you gain. That's not moral judgment, it's incentive alignment. The system doesn't ask who deserves wealth, it rewards who can hold it the longest. And here's where public narratives start to diverge from reality. During crashes, headlines focus on volatility, on fear, on uncertainty. But beneath the noise, contracts are being signed, assets are being transferred, market share is consolidating, quietly. By the time recovery is declared,